Hello and welcome. In this course, we will explore earnings per share based on International Accounting Standard 33. Earnings per share, commonly referred to as EPS, is governed by IAS 33, which was originally issued in 1997 and later adopted by the International Accounting Standards Board in April 2001. In December 2003, the standard was revised and the title was updated to simply earnings per share. The revision also included guidance from a related interpretation that addresses financial instruments and other contracts that might be settled in shares. Over time, several other standards have made minor amendments to IAS 33. These include updates introduced by IFRS 10 on consolidated financial statements, IFRS 11 on joint arrangements, IFRS 13 on fair value measurement, the amendments to IAS 1 concerning the presentation of items of other comprehensive income, and IFRS 9 on financial instruments. These changes were issued between 2011 and 2014 and help ensure that IAS 33 remains consistent with developments in financial reporting. International Accounting Standard 33, which deals with earnings per share, is organized into paragraphs 1 through 76 along with two appendices. Each paragraph carries equal authority, following the original format of the standard when it was adopted. To fully understand IAS 33, it should be considered in the context of its overall objective, the basis for conclusions, the preface to IFRS standards, and the conceptual framework for financial reporting. Additionally, IAS 8 on accounting policies, changes in accounting estimates, and errors provides guidance for choosing and applying accounting policies when there is no specific instruction available. The objective of IAS 33, which addresses earnings per share, is to provide guidance on how earnings per share should be calculated and presented. The standard is organized into 76 paragraphs and includes two appendices, with each paragraph carrying equal authority while maintaining the original format from when it was adopted. To properly apply IAS 33, it should be considered alongside its overall objective, the basis for conclusions, the preface to IFRS standards, and the conceptual framework for financial reporting. When explicit guidance is not available, IAS 8 on accounting policies, changes in accounting estimates, and errors offers a framework for selecting and applying appropriate accounting policies. IAS 33 applies to the separate or individual financial statements of entities that have ordinary shares or potential ordinary shares traded in a public market, whether on a domestic or foreign stock exchange, an over-the-counter market, or local and regional markets. It also applies to entities that are filing, or in the process of filing, their financial statements with the Securities Commission or another regulatory body for the purpose of issuing ordinary shares to the public. IAS 33 also applies to the consolidated financial statements of a group that has a parent company with ordinary shares or potential ordinary shares traded in a public market, whether on a domestic or foreign stock exchange, an over-the-counter market, or regional markets. It similarly covers parent companies that are filing or planning to file their financial statements with a Securities Commission or other regulatory body for the purpose of issuing ordinary shares to the public. Any entity that chooses to disclose earnings per share must calculate and present it in accordance with the requirements of this standard. When a company prepares both consolidated financial statements and separate financial statements, the disclosures required by IAS 33 are generally based on the consolidated information. If a company chooses to disclose earnings per share using its separate financial statements, this information should appear only in the separate statement of comprehensive income and not in the consolidated financial statements. Additionally, if profit or loss is presented in a separate statement, earnings per share should be included only in that statement. This standard uses specific terms with particular meanings. Anti-dilution refers to an increase in earnings per share or a reduction in loss per share that occurs when convertible instruments are assumed to be converted, when options or warrants are exercised, or when ordinary shares are issued once certain conditions are met. A contingent share agreement is an arrangement to issue shares that depends on the fulfillment of specified conditions. Contingently issuable ordinary shares are shares that can be issued for little or no cash or other consideration once certain conditions in a contingent share agreement are met. Dilution occurs when earnings per share decrease or loss per share increases because convertible instruments are assumed to be converted, options or warrants are exercised, or ordinary shares are issued upon meeting specified conditions. Options, warrants, and similar instruments give their holders the right to purchase ordinary shares. An ordinary share is an equity instrument that ranks below all other classes of equity, while a potential ordinary share is any financial instrument or contract that could entitle its holder to receive ordinary shares. Put options on ordinary shares are contracts that allow the holder to sell shares at a specified price within a certain period. Ordinary shares participate in the company's profits only after other types of shares, such as preference shares, have received their share. A company may have multiple classes of ordinary shares, but shares within the same class have equal rights to receive dividends. Examples of potential ordinary shares include financial liabilities or equity instruments like preference shares that can be converted into ordinary shares, options, and warrants, and shares that may be issued once certain conditions are met, such as through the purchase of a business or other assets. This standard uses terms defined in IAS 32 on financial instruments, presentation, including financial instrument, financial asset, financial liability, and equity instrument, unless stated otherwise. IAS 32 provides guidance on how to apply these definitions. Additionally, IFRS 13 on fair value measurement defines fair value and outlines the requirements for applying that definition. Basic earnings per share is calculated to show the portion of profit or loss that belongs to ordinary equity holders of the parent company. It is also calculated for profit or loss from continuing operations when that information is presented. To determine basic earnings per share, the profit or loss attributable to ordinary equity holders is divided by the weighted average number of ordinary shares outstanding during the period. The purpose of this measure is to give shareholders a clear understanding of the performance of each ordinary share over the reporting period. For calculating basic earnings per share, the amounts attributable to ordinary equity holders of the parent company include profit or loss from continuing operations and total profit or loss for the period. These amounts are adjusted to account for after-tax preference dividends, any differences arising from the settlement of preference shares, and other similar effects of preference shares classified as equity. All income and expense items attributable to ordinary equity holders, including tax expenses and dividends on preference shares classified as liabilities, are included in determining the profit or loss for the period that belongs to ordinary equity holders. When calculating earnings for basic earnings per share, the after-tax amount of preference dividends is deducted from profit or loss. This includes the after-tax amount of dividends declared for non-cumulative preference shares during the period, as well as the after-tax amount of dividends required for cumulative preference shares, whether or not they have been declared. However, it does not include any dividends for cumulative preference shares that are paid or declared in the current period for previous periods. Some preference shares are designed with a low initial dividend to compensate the company for selling the shares at a discount, or with higher dividends later to compensate investors who purchase the shares at a premium. These are often called increasing rate preference shares. Any original discount or premium on such shares is amortized to retained earnings using the effective interest method and treated as a preference dividend when calculating earnings per share. If preference shares are repurchased through a tender offer, any amount paid above the carrying value represents a return to the shareholders and is recorded as a reduction in retained earnings. This amount is deducted when determining the profit or loss attributable to ordinary equity holders of the parent company. Sometimes a company may encourage early conversion of convertible preference shares by offering more favorable conversion terms or additional consideration. When the fair value of the ordinary shares or other consideration given exceeds the fair value of the shares that would have been issued under the original terms, this excess is considered a return to the preference shareholders and is deducted when calculating profit or loss attributable to ordinary equity holders. Conversely, if the carrying amount of the preference shares exceeds the fair value of the consideration paid to settle them, this excess is added when determining the profit or loss attributable to ordinary equity holders of the parent company. When calculating basic earnings per share, the number of ordinary shares is determined using the weighted average of shares outstanding during the period. This approach takes into account that the number of shares can change over time, reflecting any shares that were issued or bought back during the period. The weighted average is calculated by starting with the number of shares at the beginning of the period and adjusting for shares issued or repurchased multiplied by a time factor. This factor represents the portion of the period that each share was outstanding, and in many cases, a reasonable approximation of the weighted average is sufficient. Shares are generally included in the weighted average number from the date the consideration for them is receivable, which is usually the date they are issued. For example, ordinary shares issued for cash are included when the cash is receivable. Shares issued through the voluntary reinvestment of dividends are included when the dividends are reinvested. Shares issued from the conversion of a debt instrument are counted from the date that interest stops accruing. Similarly, shares issued in place of interest or principal on other financial instruments are included from the date interest stops accruing, and shares issued to settle a liability of the company are included from the settlement date. Ordinary shares issued as payment for an asset other than cash are included in the weighted average number of shares from the date the acquisition is recognized. Similarly, shares issued in exchange for services are included as the services are provided. The timing for including ordinary shares depends on the terms and conditions of their issue, taking into account the substance of any associated contracts. When shares are issued as part of the consideration in a business combination, they are included from the acquisition date, since the acquiring company includes the profits and losses of the acquired entity in its statement of comprehensive income from that date. Ordinary shares that are issued upon the conversion of a mandatorily convertible instrument are included in the calculation of basic earnings per share from the date the contract is signed. Contingently issuable shares, on the other hand, are counted as outstanding only from the date when all required conditions have been met. Shares that are issued simply after the passage of time are not considered contingently issuable because the passage of time is certain. Ordinary shares that are contingently returnable, meaning they could be recalled, are excluded from the calculation until they are no longer subject to recall. The weighted average number of ordinary shares for the period and for all periods presented should be adjusted for events that change the number of shares outstanding without any corresponding change in the company's resources. This can occur when shares are issued or reduced in number without affecting resources. Examples of such events include a capitalization or bonus issue, a bonus element in other share issues such as a rights issue, a share split, or a reverse share split where shares are consolidated. In a capitalization or bonus issue or in a share split, ordinary shares are issued to existing shareholders without any additional payment. As a result, the total number of shares increases without any change in the company's resources. When calculating the weighted average number of shares, the number of shares outstanding before the event is adjusted proportionally, as if the event had occurred at the beginning of the earliest period presented. For example, in a 2-for-1 bonus issue, the original number of shares is multiplied by 3 to determine the new total, or by 2 to determine the additional shares issued. A consolidation of ordinary shares usually reduces the number of shares outstanding without affecting the company's resources. However, if the consolidation is effectively a share repurchase at fair value, the reduction in shares corresponds to a reduction in resources, such as when a consolidation is combined with a special dividend. In such cases, the weighted average number of shares for the period is adjusted to reflect the reduction from the date the special dividend is recognized. Diluted earnings per share is calculated to show the impact of all potential ordinary shares on profit or loss attributable to ordinary equity holders of the parent company. This also applies to profit or loss from continuing operations when that information is presented. To determine diluted earnings per share, both the profit or loss and the weighted average number of shares are adjusted to reflect the effects of all dilutive potential ordinary shares. The objective of diluted earnings per share is similar to that of basic earnings per share, to show the interest of each ordinary share in the performance of the company. However, diluted earnings per share also reflects all potential ordinary shares that could dilute earnings. To calculate it, profit or loss attributable to ordinary equity holders is adjusted by adding the after-tax amount of dividends and interest related to dilutive potential ordinary shares, along with any other income or expense changes that would result from their conversion. At the same time, the weighted average number of ordinary shares is increased to include the additional shares that would be outstanding if all dilutive potential ordinary shares were converted. When calculating diluted earnings per share, the profit or loss attributable to ordinary equity holders is adjusted to reflect the after-tax effects of certain items. These include any dividends or other amounts related to dilutive potential ordinary shares that were previously deducted, any interest recognized during the period associated with these shares, and any other income or expense changes that would result if the dilutive potential ordinary shares were converted. Once potential ordinary shares are converted into ordinary shares, the items previously deducted, such as dividends, interest, or other related amounts, no longer apply. Instead, the new ordinary shares become entitled to participate in the profit or loss attributable to ordinary equity holders of the parent company. Therefore, profit or loss is adjusted to reflect these items and any related taxes. Expenses related to potential ordinary shares, including transaction costs and discounts, are accounted for using the effective interest method. The conversion of potential ordinary shares can lead to additional changes in income or expenses. For example, if interest expense related to these shares is reduced, profit may increase or loss may decrease, which in turn could increase the expense for a non-discretionary employee profit-sharing plan. When calculating diluted earnings per share, profit or loss attributable to ordinary equity holders is adjusted to reflect any such consequential changes in income or expense. When calculating diluted earnings per share, the total number of ordinary shares includes the weighted average number of shares already outstanding, plus the weighted average number of shares that would be issued if all dilutive potential ordinary shares were converted. These potential shares are considered to have been converted at the beginning of the period or, if issued later, from the date they were issued. Dilutive potential ordinary shares are determined separately for each reporting period, and the total for a year-to-date period is not calculated as a weighted average of the interim periods. Potential ordinary shares are weighted according to the period they are outstanding. Shares that are canceled or allowed to lapse during the period are included only for the portion of the period they were outstanding. Shares that are converted into ordinary shares during the period are counted from the beginning of the period until the conversion date, after which the resulting ordinary shares are included in both basic and diluted earnings per share. The number of shares issued upon conversion is determined by the terms of the potential ordinary shares, and when multiple conversion options exist, the calculation assumes the most favorable conversion rate or exercise price for the holder of the potential shares. A subsidiary, joint venture, or associate may issue potential ordinary shares to parties other than the parent company or other investors with joint control or significant influence. These shares may be convertible into ordinary shares of the subsidiary, joint venture, associate, or even the parent or controlling investors. If these potential shares have a dilutive effect on the basic earnings per share of the reporting entity, they must be included in the calculation of diluted earnings per share. Potential ordinary shares are considered dilutive only if their conversion into ordinary shares would reduce earnings per share or increase loss per share from continuing operations. To determine this, a company uses profit or loss from continuing operations attributable to the parent company as the reference point. This profit or loss is adjusted for certain items and excludes any amounts related to discontinued operations. Potential ordinary shares are considered anti-dilutive if converting them into ordinary shares would increase earnings per share or reduce loss per share from continuing operations. When calculating diluted earnings per share, any potential shares that would have an anti-dilutive effect are not assumed to be converted, exercised, or otherwise issued. When deciding whether potential ordinary shares are dilutive or anti-dilutive, each issue or series of shares is considered separately, not in total. The order in which they are considered can affect the result. To maximize the dilution of basic earnings per share, shares are evaluated in sequence from the most dilutive to the least dilutive. This means that shares with the lowest earnings per incremental share are included first in the diluted earnings per share calculation, followed by those with higher earnings per incremental share. Options and warrants are usually included first because they do not change the profit or loss used in the calculation. When calculating diluted earnings per share, a company assumes that all dilutive options and warrants are exercised. The proceeds from these instruments are considered to have been received from issuing ordinary shares at the average market price during the period. The difference between the number of shares issued and the number that would have been issued at the average market price is treated as if the shares were issued for no consideration. Options and warrants are considered dilutive if they would lead to the issuance of ordinary shares for less than the average market price during the period. The extent of the dilution is the difference between the average market price and the issue price. To calculate diluted earnings per share, potential ordinary shares are treated as two parts. The first part is a contract to issue a number of shares at the average market price, which are assumed to be fairly priced and therefore neither dilutive nor anti-dilutive, and are ignored in the calculation. The second part is a contract to issue the remaining shares for no consideration. These shares generate no proceeds and do not affect profit or loss, making them dilutive and added to the number of ordinary shares used in the calculation of diluted earnings per share. Options and warrants are dilutive only when the average market price of ordinary shares during the period is higher than the exercise price, meaning they are in the money. Previously reported earnings per share are not adjusted retroactively for changes in share prices. For share options and other share-based payment arrangements covered by IFRS 2, the issue price and exercise price include the fair value of any goods or services to be provided to the company in the future under the arrangement. Employee share options with fixed or determinable terms, as well as non-vested ordinary shares, are treated as options when calculating diluted earnings per share, even if their vesting is contingent. These shares are considered outstanding from the grant date. Performance-based employee share options, however, are treated as contingently issuable shares because their issuance depends on meeting specific performance conditions in addition to the passage of time. The impact of convertible instruments is included in diluted earnings per share by adjusting both profit and the number of shares, as previously described. Convertible preference shares are considered anti-dilutive if the dividend per ordinary share obtained on conversion is higher than basic earnings per share for the period. Similarly, convertible debt is anti-dilutive if the interest, after tax, and other relevant adjustments per ordinary share obtainable on conversion exceeds basic earnings per share. When only some of the previously outstanding convertible preference shares are redeemed or converted, any excess consideration is attributed to those specific shares for the purpose of determining whether the remaining shares are dilutive. The shares that are redeemed or converted are treated separately from those that remain outstanding. In calculating diluted earnings per share, contingently issuable ordinary shares are treated as outstanding and included if the required conditions have been met. These shares are included from the beginning of the period or from the date of the contingent share agreement if that is later. If the conditions are not yet satisfied, the number of shares included is based on the amount that would be issuable if the contingency period ended at the reporting date. No restatement is made if the conditions remain unmet when the contingency period ends. If the issuance of shares depends on achieving or maintaining a specific level of earnings, and that level is met at the end of the reporting period but must be maintained for a further period, the additional shares are treated as outstanding for diluted earnings per share if the effect is dilutive. In this calculation, the number of shares is based on what would be issued if the earnings at the end of the reporting period equaled the earnings at the end of the contingency period. However, for basic earnings per share, these shares are not included until the contingency period ends, since not all conditions have yet been satisfied. The number of contingently issuable ordinary shares may depend on the future market price of the shares. If the effect is dilutive, diluted earnings per share are calculated based on the number of shares that would be issued if the market price at the end of the reporting period equaled the market price at the end of the contingency period. If the condition is based on an average market price over a period extending beyond the reporting period, the calculation uses the average for the portion of the period that has passed. For basic earnings per share, these shares are not included until the end of the contingency period, since the necessary conditions have not yet been fully met. The number of contingently issuable ordinary shares may depend on both future earnings and the future market price of the shares. In such cases, the calculation of diluted earnings per share includes these shares only if both conditions are satisfied. The number of shares used is based on the earnings achieved to date and the current market price at the end of the reporting period. If either condition is not met, the shares are excluded from the calculation. In some cases, the number of contingently issuable ordinary shares depends on conditions other than earnings or market price, such as opening a certain number of retail stores. For diluted earnings per share, these shares are included based on the status of the condition at the end of the reporting period, assuming that the condition remains unchanged until the end of the contingency period. Contingently issuable potential ordinary shares other than those covered by a contingent share agreement are included in the calculation of diluted earnings per share based on the conditions for their issuance. The company first determines whether these potential shares can be assumed to be issuable according to the rules for contingent ordinary shares. If the potential ordinary shares are to be included in diluted earnings per share, the company determines their effect by applying the rules for options and warrants, convertible instruments, contracts settled in shares or cash, or other relevant provisions. However, the exercise or conversion of these shares is assumed only if similar outstanding potential ordinary shares that are not contingently issuable are also assumed to be exercised or converted. When a company issues a contract that can be settled in either ordinary shares or cash at its option, it is assumed for diluted earnings per share that the contract will be settled in shares. The potential shares created are included in the calculation if they have a dilutive effect. If the contract is recorded as an asset or liability, or has both an equity and a liability component, the company adjusts profit or loss for any changes that would have occurred if the contract were classified entirely as equity, similar to other adjustments made for dilutive shares. For contracts that can be settled in either ordinary shares or cash at the holder's option, the method that produces the most dilution is used when calculating diluted earnings per share. Examples include a debt instrument that allows the company to repay the principal in cash or shares at maturity, and a written put option that gives the holder the choice to settle in cash or ordinary shares. Purchased options such as put or call options held by the company on its own ordinary shares are not included in the calculation of diluted earnings per share. Including them would increase earnings per share rather than dilute it, because a put option would be exercised only if its exercise price is above the market price, and a call option would be exercised only if its exercise price is below the market price. Contracts that require a company to repurchase its own shares, such as written put options or forward purchase contracts, are included in diluted earnings per share if they have a dilutive effect. When these contracts are in the money, meaning the exercise or settlement price is above the average market price during the period, the potential impact on earnings per share is calculated according to the specific rules for such instruments. For calculating diluted earnings per share, it is assumed that at the beginning of the period, the company issues enough ordinary shares at the average market price to raise the funds needed to satisfy the contract. The proceeds from this share issue are then used to fulfill the contract by repurchasing the shares. The difference between the number of shares issued and the number of shares repurchased, called the incremental shares, is included in the calculation of diluted earnings per share. When the number of ordinary or potential ordinary shares changes due to a bonus issue, share split, or reverse share split, the calculation of both basic and diluted earnings per share must be adjusted retrospectively for all periods presented. If these changes happen after the reporting period, but before the financial statements are authorized for issue, the per share calculations for that period and any prior periods presented are based on the updated number of shares. Companies must disclose that per-share calculations reflect changes in the number of shares. Basic and diluted earnings per share for all periods presented are also adjusted for errors and changes in accounting policies applied retrospectively. However, diluted earnings per share for prior periods are not restated for changes in assumptions used in the calculations or for the conversion of potential ordinary shares into ordinary shares. In the Statement of Comprehensive Income, a company must present both basic and diluted earnings per share for profit or loss from continuing operations and for overall profit or loss attributable to ordinary equity holders. This presentation applies to each class of ordinary shares that has different rights to share in the profit. Basic and diluted earnings per share must be displayed with equal prominence for all periods shown. If diluted earnings per share is reported for any period, it must be reported for all periods, even if it is the same as basic earnings per share. When basic and diluted earnings per share are equal, they can be shown together in a single line. When a company presents items of profit or loss in a separate statement, basic and diluted earnings per share must be included in that statement. For discontinued operations, the company must disclose the basic and diluted amounts per share, either in the Statement of Comprehensive Income or in the notes. Even if the earnings per share amounts are negative, meaning a loss per share, they must still be presented. A company must provide clear information on how it calculates earnings per share. This includes disclosing the amounts used as the numerators for basic and diluted earnings per share and showing how these amounts reconcile to the profit or loss attributable to the parent company for the period. The reconciliation should detail the impact of each class of instruments that affects earnings per share. Similarly, the company must disclose the weighted average number of ordinary shares used as the denominator for basic and diluted earnings per share and provide a reconciliation of these numbers, including the effect of each class of instruments. A company must also disclose instruments, including contingently issuable shares, that could potentially dilute basic earnings per share in the future, but were not included in the calculation of diluted earnings per share because they are anti-dilutive for the periods presented. Additionally, the company should provide a description of any ordinary share transactions or potential ordinary share transactions that occurred after the reporting period, and that would have significantly changed the number of ordinary shares or potential ordinary shares outstanding at the end of the period if they had occurred before the reporting period ended. Examples of transactions that must be disclosed after the reporting period include an issue of shares for cash, an issue of shares when proceeds are used to repay debt or preference shares outstanding at the end of the reporting period, the redemption of ordinary shares, the conversion or exercise of potential ordinary shares outstanding at the end of the reporting period, the issue of options, warrants, or convertible instruments, and the achievement of conditions that would result in the issue of contingently issuable shares. Earnings per share amounts are not adjusted for such transactions because they do not affect the amount of capital used to generate profit or loss for the period. Financial instruments and other contracts that could generate potential ordinary shares may include terms and conditions affecting the measurement of basic and diluted earnings per share. These terms determine whether the potential ordinary shares are dilutive and how they impact the weighted average number of shares and any related adjustments to profit or loss attributable to ordinary equity holders. Disclosing the terms and conditions of such instruments and contracts is encouraged, even if not explicitly required. If an entity reports earnings per share for a component of the statement of comprehensive income other than what this standard requires, the calculation must still use the weighted average number of ordinary shares determined under this standard. Basic and diluted amounts per share for that component should be disclosed with equal prominence in the notes. The entity must also explain how the numerator was determined, including whether the amounts are before or after tax. If an entity calculates earnings per share using a component of the statement of comprehensive income that is not reported as a line item, it must provide a reconciliation between that component and a line item that is reported. This requirement also applies when an entity discloses amounts per share for a reported item of profit or loss other than those required by this standard. This standard is effective for annual periods beginning on or after January 1st, 2005. Earlier application is encouraged, and if applied earlier, the entity must disclose that fact. Amendments from the 2007 revision of IAS 1, including updated terminology and new paragraphs 4A, 67A, 68A, and 73A, are effective for annual periods beginning on or after January 1st, 2009. If an entity applies IAS 1, revised 2007, earlier, the amendments must also be applied for that earlier period. IFRS 10 and IFRS 11 on joint arrangements, issued in May 2011, amended paragraphs 4, 40, and A11. An entity is required to apply these amendments whenever it applies IFRS 10 and IFRS 11. IFRS 13, issued in May 2011, amended paragraphs 8, 47A, and A2. Entities shall apply these amendments when they apply IFRS 13. The amendments to IAS 1 regarding the presentation of items of other comprehensive income, issued in June 2011, updated paragraphs 4A, 67A, 68A, and 73A. These amendments must be applied when an entity applies IAS 1 as amended in June 2011. Finally, IFRS 9 on financial instruments, issued in July 2014, amended paragraph 34. Entities are required to apply this amendment when they apply IFRS 9. This standard withdraws and supersedes previous pronouncements. It replaces IAS 33 on earnings per share, which was issued in 1997. It also replaces SIC 24, which dealt with earnings per share related to financial instruments and other contracts that may be settled in shares. Appendix A provides application guidance and is considered an integral part of this standard. When calculating earnings per share based on the consolidated financial statements, profit or loss attributable to the parent entity means the profit or loss of the consolidated entity after making adjustments for non-controlling interests. When ordinary shares are issued at the time of exercise or conversion of potential ordinary shares, this usually does not create a bonus element because the shares are generally issued for fair value, which results in a proportionate change in the resources available to the entity. In the case of a rights issue, however, the exercise price is often lower than the fair value of the shares. Therefore, a rights issue includes a bonus element. If the rights issue is offered to all existing shareholders, the number of ordinary shares used to calculate basic and diluted earnings per share for periods before the rights issue is the number of shares outstanding before the issue, multiplied by a specific adjustment factor. The theoretical ex-rights fair value per share is calculated by first adding the total fair value of the shares immediately before the exercise of the rights to the proceeds received from exercising the rights. This total is then divided by the number of shares that are outstanding after the rights are exercised. If the rights are publicly traded separately from the shares before the exercise date, the fair value is measured at the close of the last day on which the shares and rights were traded together. To illustrate the control number concept, let's consider an example. An entity reports a profit from continuing operations of 4,800 currency units. At the same time, it records a loss from discontinued operations of 7,200, which results in a total loss of 2,400 currency units attributable to the parent. The entity has 2,000 ordinary shares and 400 potential ordinary shares outstanding. Based on this information, the basic earnings per share work out to 2.40 currency units for continuing operations, a negative 3.60 for discontinued operations, and a negative 1.20 for the overall loss. The 400 potential ordinary shares are taken into account when calculating diluted earnings per share because they reduce the earnings per share for continuing operations to 2 currency units. This makes them dilutive, provided that there is no profit or loss impact from those additional shares. Since the profit from continuing operations is treated as the control number, the entity also includes those 400 potential ordinary shares when calculating the other earnings per share figures. Even though the inclusion makes the results anti-dilutive, compared with the basic earnings per share, meaning the reported loss per share is smaller, the calculation still applies. As a result, the diluted loss per share is 3 currency units for discontinued operations and 1 currency unit for the overall loss. When calculating diluted earnings per share, the average market price of ordinary shares assumed to be issued is based on the average market price of those shares during the reporting period. In theory, this calculation could take into account every single market transaction for the company's ordinary shares. However, in practice, a simpler method is usually sufficient. Most entities use an average of weekly or monthly share prices, which provides a reliable and practical measure of the market price over the period. In most cases, closing market prices are sufficient for calculating the average market price of ordinary shares. But when prices fluctuate significantly, using an average of the high and low prices during the period often gives a more representative figure. Whatever method is chosen, it should be applied consistently from one period to the next, unless conditions change and the method no longer provides a fair measure. For example, a company that has relied on closing market prices for several years during a period of stability may decide to switch to the high-low average method if market prices begin to swing sharply, since closing prices alone would no longer reflect a realistic average. Options and warrants are treated as if they are exercised when calculating diluted earnings per share, but only under certain conditions. Specifically, they are assumed to be exercised to purchase a convertible instrument when the average market prices of both the convertible instrument and the ordinary shares that could be obtained upon conversion are higher than the option or warrant's exercise price. However, this assumption is only made if it's consistent with the treatment of other similar convertible instruments that are already outstanding. Sometimes options or warrants allow or even require the use of debt or other instruments of the company or of its parent or subsidiary as payment for all or part of the exercise price. When we calculate diluted earnings per share, these types of options or warrants are considered dilutive in 2 situations. First, when the average market price of the related ordinary shares during the period is higher than the exercise price. Second, when the instrument being tendered is sold at a price that is lower than the value at which it can be used in the option or warrant agreement. In that case, the discount effectively reduces the exercise price to below the market price of the shares obtained upon exercise, making the option or warrant dilutive. When calculating diluted earnings per share, these types of options or warrants are assumed to be exercised, and the related debt or other instruments are assumed to be tendered. However, if the contract also allows payment in cash, and using cash would be more advantageous for the option or warrant holder, then we assume cash is tendered instead. In this case, any interest on the debt that is assumed to be tendered, net of tax, is added back as an adjustment to the numerator of the EPS calculation. A similar approach is applied to preference shares with the same kind of provisions, or to other financial instruments that include conversion options allowing the investor to pay cash in exchange for a more favorable conversion rate. Sometimes, the terms of certain options or warrants require that the proceeds from exercising them must be used to redeem debt or other instruments of the company, its parent, or a subsidiary. In calculating diluted earnings per share, these options or warrants are treated as if they were exercised, and the proceeds are assumed to be used to repurchase the debt at its average market price instead of buying ordinary shares directly. If there are any excess proceeds left after this assumed debt repurchase, we then treat those as if they were used to buy back ordinary shares, and that effect is included in the diluted earnings per share calculation. In addition, any interest on the debt that is assumed to be repurchased, net of tax, is added back to the numerator of the EPS calculation. Let's look at how written put options affect the calculation of diluted earnings per share. Imagine a company has 120 written put options on its ordinary shares, each with an exercise price of 35 currency units. The average market price of those shares during the period is only 28. To meet its put obligation of 4,200 currency units, the company is assumed to issue 150 shares at 28 each right at the start of the period. In exchange, it receives 120 shares from the holders of the put options. That leaves a difference of 30 shares. These 30 incremental shares are added to the denominator when calculating diluted earnings per share. When calculating diluted earnings per share, potential ordinary shares of a subsidiary, joint venture, or associate are considered if they can be converted into ordinary shares of either the subsidiary, joint venture, associate, or the parent company, or other investors with joint control or significant influence over the investee. If these instruments are issued by a subsidiary, joint venture, or associate and allow holders to obtain ordinary shares of that entity, they are first included in the earnings per share calculation of the subsidiary, joint venture, or associate itself. After that, those earnings per share figures are incorporated into the reporting entity's own earnings per share calculations, in proportion to the reporting entity's holding of the instruments in the subsidiary, joint venture, or associate. Instruments of a subsidiary, joint venture, or associate that can be converted into ordinary shares of the reporting entity are treated as potential ordinary shares of the reporting entity when calculating diluted earnings per share. Similarly, options or warrants issued by a subsidiary, joint venture, or associate that allow the purchase of ordinary shares of the reporting entity are also included as potential ordinary shares of the reporting entity in the calculation of consolidated diluted earnings per share. To determine the earnings per share effect of instruments issued by a reporting entity that are convertible into ordinary shares of a subsidiary, joint venture, or associate, the instruments are assumed to be converted. The numerator, which is the profit or loss attributable to ordinary equity holders of the parent entity, is adjusted as necessary. In addition to these adjustments, the numerator is further adjusted for any change in the profit or loss recorded by the reporting entity, such as dividend income or equity method income, that is attributable to the increase in the number of ordinary shares of the subsidiary, joint venture, or associate resulting from the assumed conversion. The denominator in the diluted earnings per share calculation is not affected because the number of ordinary shares of the reporting entity outstanding does not change upon this assumed conversion. The equity of some entities includes instruments that participate in dividends with ordinary shares according to a predetermined formula, such as 2-for-1, sometimes with an upper limit on the extent of participation, for example, up to a specified amount per share. It may also include a class of ordinary shares with a different dividend rate from another class of ordinary shares, but without prior or senior rights. For the purpose of calculating diluted earnings per share, conversion is assumed for instruments that are convertible into ordinary shares if the effect is dilutive. For instruments that are not convertible into a class of ordinary shares, profit or loss for the period is allocated to the different classes of shares and participating equity instruments according to their dividend rights or other rights to participate in undistributed earnings. To calculate basic and diluted earnings per share, profit or loss attributable to ordinary equity holders of the parent entity is adjusted. A profit is reduced, and a loss is increased by the amount of dividends declared in the period for each class of shares, and by the contractual amount of dividends or interest on participating bonds that must be paid for the period, for example, unpaid cumulative dividends. The remaining profit or loss is allocated to ordinary shares and participating equity instruments to the extent that each instrument shares in earnings, as if all of the profit or loss for the period had been distributed. The total profit or loss allocated to each class of equity instrument is determined by adding together the amount allocated for dividends and the amount allocated for a participation feature. The total amount of profit or loss allocated to each class of equity instrument is then divided by the number of outstanding instruments to which the earnings are allocated in order to determine the earnings per share for that instrument. For the calculation of diluted earnings per share, all potential ordinary shares assumed to have been issued are included in the outstanding ordinary shares. Where ordinary shares are issued but not fully paid, they are treated in the calculation of basic earnings per share as a fraction of an ordinary share, based on the extent to which they were entitled to participate in dividends during the period relative to a fully paid ordinary share. To the extent that partly paid shares are not entitled to participate in dividends during the period, they are treated as the equivalent of warrants or options in the calculation of diluted earnings per share. The unpaid balance is assumed to represent proceeds used to purchase ordinary shares, and the number of shares included in diluted earnings per share is the difference between the number of shares subscribed and the number of shares assumed to be purchased. Appendix B covers amendments to other pronouncements. These amendments are to be applied for annual periods beginning on or after the 1st of January 2005. If an entity applies the standard for an earlier period, the amendments should also be applied for that earlier period. The amendments that were included in this appendix when the standard was revised in 2003 have already been incorporated into the relevant pronouncements published in this volume. IAS 33, earnings per share, as revised in 2003, was approved for issue by the 14 members of the International Accounting Standards Board. The approval was given under the chairmanship of Sir David Tweedy, with Thomas E. Jones serving as vice chairman. Other board members included Mary E. Barth, Hans-Georg Bruns, Anthony T. Cope, Robert P. Garnett, Gilbert Gellard, James J. Leisenring, Warren J. McGregor, Patricia L. O'Malley, Harry K. Schmidt, John T. Smith, Jeffrey Whittington, and Tatsumi Yamada. Thank you for completing our course and for the attention and dedication you've shown throughout. We are happy to have contributed to your professional development and encourage you to help us improve by providing your feedback. If you have any questions or suggestions, feel free to reach out via email at info@qlever.al or through the contact forms on our website. Also, we invite you to follow us on social media and our YouTube channel to stay updated on upcoming training sessions. Thank you once again, and we look forward to seeing you in our future courses.